Hi everybody, it's me again. I've got a spreadsheet here for Home and Garden Warehouse. This is chapter 14, showing the balance sheet for 2014 and 2013 and income statement for the same years. And from that, we want to calculate the various ratios that indicate how strong and how financially sound this company is. The first one we want to take, the first group of them, is the turnover ratios, which measures the efficiency with which a firm is being operated. And the first one is the asset turnover. And the asset turnover takes the total assets of 2,084,308 and divides that into the numbers to the sales. So it says that the assets turnover 1.32 times as compared with the sales. Then we want to take the receivables. Now receivables, we take that one and we take the receivables of 70,150 and divide that into the sales of 2,766,429 and turns over 39.4 times. That's really good. And so they don't have much receivables, as you can see from this, and that even shows up more succinctly when we look at the day sales in receivables. They collect the receivables every 9 days. So they've really got quite a cash sale here, and they don't have much credit sales. But let's calculate it. The day sales in receivables really takes the sales and comes up with what they want. We want to calculate the average daily sales, and we divide that number into the receivables. So you can see that we take this 2,766,425 and divide that by 365, and that number gets divided into the receivables to come up with 9.256. Another way of doing it, though, is to take this the receivable turnover, and divide that into 365 days, and that tells you how many days it takes to collect the receivables. Take the inventory turnover. The receivables turned over 39 times. The inventory turns up only 3 times. This represents a major problem for this company. They've got receivables that's sitting around and not selling very well. And that comes up with taking this cost of sales of 1,942,654 and dividing that by the $641,280 of inventory. Now, another way of looking at it is day sales in inventory, and they really shows up, and you take that, you take 365 days and divide that by 3, and it says those days in inventory don't get turned over. It takes 120 days, and last year it was even worse. So they've got a big problem here. Now let's take a look at the earnings per share and see how profitable they are. So to take the earnings per share, we're going to take the earnings of 155,793 and divide that by the number of shares, which is 465 shares. 465,000 shares. So that says we earn $33.50 to eat for each share of stock. Now, we come up with the price earnings ratio, and that we are going to take the sales per share, the share price of $5.05 and divide that by 33.5 cents. And that comes up with a price earnings ratio of $15.07. Then we go from there to gross margin. Now the gross margin takes the gross profit of 823,771 and divides that by the sales. So that says that on those sales we make gross profit is 29.8%. It's about the same as it was last year. Now return on assets is they've got an interesting wrinkle in here. You take this 150, this is the net earnings of 155,793, and you add to that number the after-tax cost of the interest, which is 14,747, times 0.65 because the tax cost here is 37 or 35%. So the reciprocal of that is 6.65, and that's what we multiply that interest expense by, and then we add that after-tax cost to the net earnings, and that total gets divided by the total assets to come up with the return on assets. Some companies just take the 155,000 and hold that over the total assets, but each company has its own little wrinkle in these kinds of things. For example, in the return on equity, it doesn't make any changes. It just takes 155,000, the net earnings, $155,793, and divides that by the stockholders' equity to come up with a 10.5%, which is not very good. So they're not very profitable. And last year it was even worse. Now, the current ratio, we're going to see some problems here too. The current ratio, as you know, takes the current assets and divides that by the current liabilities. Well, you take those assets, current assets, with that inventory, big inventory stuck in there, and it makes the current ratio look respectable. But if you do what they call the acid test ratio and pull that inventory out of there, and then you only have cash and receivables, and you divide that by the current liabilities, you can see they've got a problem, a real serious problem here, because usually you've got to have your current assets. It's got to be sufficient to pay the current liabilities, and they're not there. Then the debt to equity ratio takes the total debt of $602,106 and compares that with the stockholders' equity, and so it comes up with 0.406. That's significantly higher than it was last year. Times interest earned. They can pay their interest quite a lot. They've got interest it takes the interest expense of $14,747, divides that into the total operating income, and you can see 17 times. Now, the preceding year they could pay it 53 times because the interest is really a lot lower. I hope this gives you a pretty good idea of how these ratios get calculated, and you can see that there's some real problems with this business, and they've got some things to work out. Thank you very much. Oh.